market is exploding and all my favorite stocks are on sale, and yours probably are as well. Hello everyone, welcome back to Profit Playfield. My name is Zach. Today we're diving into 5 stocks that could make big moves in 2025, from tech giants to financial disruptors, including Google, Discover, Stellantis, SoFi, and NVIDIA. Let's break down why these are on my watch list and why you might want to keep an eye on them too. For more investing and stock market content, make sure to leave a like and subscribe for more. First up, Alphabet, Google. Google's parent company. Why am I bullish on Google for 2025? Google is one of those stocks that has the rare combination of growth potential and stability. And in 2025, that's more important than ever. The most recent dip is a rare opportunity and could be a great entry point with all the overselling in the tech industry among the Magnificent Seven. Let's start with Google's leadership in AI. Google has been investing heavily in artificial intelligence and Gemini AI. Their advanced AI model is positioning them as a direct competitor to OpenAI and Microsoft's Bing AI. Google is not just playing catch up, they're leading in AI advancements. And this could translate to higher advertising revenue and cloud growth. Google Cloud continues to show impressive gains in market share, and it's still a fraction of the size of AWS, Amazon Web Services, and Azure, meaning there's plenty more room for growth. Google has announced plans to invest approximately $75 billion in capital expenditures for 2025, with a significant portion allocated to enhancing their artificial intelligence, AI, and cloud infrastructure. This investment represents a substantial increase from the $52.5 billion spent in 2024. The funds will primarily focus on expanding data centers, servers, and networking capabilities to meet the growing demand for AI services. Google CEO Sundar Pichai, a name that I probably mispronounced, emphasized that these investments aim to accelerate progress in AI innovation and strengthen the company's core businesses. YouTube is another major contributor. The platform has continued to dominate in video advertising, and with its YouTube Shorts feature, it's taking on TikTok directly. In 2024, YouTube's advertising revenue reached a record $36.1 billion, surpassing previous figures and solidifying its position as a dominant force in the digital advertising landscape. This impressive performance not only highlights YouTube's robust growth, but also underscores its significant contribution to Alphabet Inc.'s overall financial success. For instance, in the recent quarter, Alphabet reported a 15% increase in revenue, totaling $88.3 billion, with Google's services, including YouTube, playing a pivotal role in this upsurge. When compared to other platforms, YouTube's ad revenue outpaces many competitors, reflecting its expansive user base and effective monetization strategies. This growth is particularly beneficial to Google as it diversifies the company's revenue streams beyond search advertising, enhances its market share in the digital ad space, and reinforces its competitive edge in the evolving landscape of online media consumption, such as TikTok and short-form content. Not to mention, Google's diversification into hardware with products like the Pixel phone and Google Home smart devices adds to the overall stability and diversification of the business. Google is one of the most undervalued stocks in the Magnificent Seven right now, with a PE, price to earnings ratio, of 21. It's quite low. When looking at price targets from October 2024 to February, the stock has an estimated price target overall of $212.29 per share. After the market realizes how oversold the tech sector has been in retaliation to tariffs and other fears such as DeepSeek with NVIDIA and AI, everything should, I believe, come back to previous levels and surge beyond that. What's my price target for 2025? I'm predicting a potential rise to $200 per share in 2025. Depending on the success of their AI initiatives and continued growth in cloud and advertising, the bounce back would reflect a modest increase. It's nothing too crazy as it was at $200 previously earlier this month. Anything under $200 for me is a strong buy. Next up is Discover Financial Services, DFS. Now, you might not hear about DFS as often as big players like Visa and MasterCard, but this company has a lot going for it and could be one of the best financial plays of 2025. Discover is not just a credit card company. They are a diversified financial institution with a strong presence in direct banking, student loans, and personal loans, which makes them more than just a one-trick pony. What makes DFS attractive right now is their profitability and growth potential. Despite the volatility in the financial sector, DFS has managed to keep its balance sheet strong. and a high interest rate environment is actually helping their margins in credit cards and personal loans. But the most exciting part, Discover's digital transformation. Their banking platform continues to innovate with features like no-fee checking accounts, cashback rewards, and high-yield savings accounts that are attracting a younger demographic. Plus, DFS's low cost of capital compared to its competitors makes them a potential winner if interest rates begin to normalize. Something to note is among their strong standing as an individual company, Discover is soon going to merge with Capital One after proposed recent buyout, making this group the third largest credit card company behind Visa and MasterCard, directly challenging their duopoly. In February 2024, Capital One proposed acquiring Discover Financial Services in an all-stock deal valued at $35.3 billion. Stockholders of both companies recently approved the merger in the separate meetings on February 2025, a year later. The deal is expected to close still in early 2025 and has been the case for over a year. It's currently pending approval from the Federal Reserve and the Office of the Comptroller of the Currency, which currently both seem like they will approve later this May. Discover says it now expects to finalize its proposed merger with Capital One specifically on May 19th, although later than originally planned, it is no longer a matter of if, but when. So the Credit Card Competition Act, which I talk about in another video, could weaken Visa and MasterCard's dominance by requiring more network competition for transaction processing. Discover, DFS, is as the fourth largest US payment network before the merger could gain issuer interest, increasing transaction volume and network adoption. With potential regulatory challenges forcing more competition, merchants may increase acceptance of Discover cards, reducing reliance on Visa and MasterCard and expanding DFS's transaction volume. Also, the Capital One acquisition of Discover creates a financial powerhouse that combines a major issuer, COF, with an established payment network, DFS, making it a stronger competitor against Visa and MasterCard. This could lead to improved negotiating power with merchants and greater cost efficiency across the board. If forced competition leads more banks to route transactions through Discover's network, DFS could see higher interchange fees and processing revenues, improving its profitability and long-term growth outlook, which obviously will affect the stock. With the combined strength of Capital One and Discover, the merged entity could attract more co-branded partnerships from retailers seeking alternative payment networks, further expanding Discover's ecosystem. So swipe fees for the majority of retailers and banks and issuers, the majority of the fees that they pay are in these swipe fees, which come directly from Visa and MasterCard. If there is another competitor that enters the sphere as the Credit Card Competition Act pushes, this could greatly disrupt that sphere and benefit whatever third, fourth, or fifth party come in as the main competitor. Right now, Discover is not guaranteed, but with the merger being the third largest, basically, bank issuer, credit card issuer. So, as a potential upside, as the market recovers and consumer spending ramps up, DFS could see significant growth. And I'm projecting a huge rise in stock price over the next year and into the next 5 years, especially if interest rates start to come down. Similar to Google, as previously talked about, any price under $200 to me is a strong buy, as I have a price target set for 2025 of $230 per share and plan on holding for over the next 5 years. I am buying shares of DFS, understanding that is soon going to be under premium share buyback and trusting DFS's business model if the deal somehow does not go through. The stock premium for the merger of Capital One and Discover was 26.6%. This means that Discover shareholders will receive 1.0192 Capital One shares for every Discover share that they currently own. Now let's talk about my third stock pick, Stellantis, ticker symbol STLA, the auto giant that's flying under the radar and has faced massive overselling this past year. Stellantis owns brands such as Jeep, Dodge, Chrysler, and Maserati. And while the auto industry is facing headwinds, Stellantis has been very strategic in positioning itself for future growth. Stellantis entered 2024 with ambitious goals to expand its electric vehicle (EV) lineup, strengthen its global presence, and maintain profitability across both EV and ICE internal combustion engine sectors. The company plans to launch 48 new battery electric vehicles (BEVs), invest $1.62 billion in Leap Motor to expand its EV footprint, and allocate $6 billion toward flex fuel ICE engine development in South America. While challenges arose, Stellantis remains well positioned for long-term growth success as it adapts to shifting market conditions. Despite a 70% drop in net profit from 20.1 billion to 5.9 billion and a 17% revenue decline from 204.6 billion to 169.4 billion, Stellantis made strategic moves to secure its future. The Leap Motor partnership advanced the company's global EV strategy, even if the full impact has yet to be realized. Although Maserati adjusted to its EV plans and pulled out of the deal, Stellantis continues to refine its approach to electrification based on consumer demand, especially with the whole political climate going on right now. There could be a lot of changes here. In the ICE sector, the company's $6 billion investment in flex fuel technology positions it well in markets where EV adoption remains gradual, ensuring continued revenue streams. With a diversified approach, Stellantis is balancing near-term profitability with long-term innovation. While recent news of CEO Carlos Tavares stepping down in late 2024 in December, his leadership helped lay the foundation for Stellantis' transition into the future of mobility. With restructuring efforts underway currently and a strong commitment to technological advancement and market adaptability, Stellantis is poised for a rebound in 2025, focusing on profitable EV growth, sustainable ICE innovation, and global market expansion. STLA is actively investing in AI across multiple areas of its business. It partnered with Mistral AI to develop an AI-powered in-car assistant and enhance vehicle engineering, sales, and manufacturing. The acquisition of AI Motive in 2022 bolstered its autonomous driving capabilities. AI is also improving manufacturing efficiency through cloud-based digital twins and anomaly detection. The company launched STLA AutoDrive, an in-house autonomous driving system for hands-free driving. Stellantis continues to integrate AI to enhance vehicle features, optimize production, and improve customer experience. As AI growth continues and bounces back from this oversell period it's in right now, that I believe, this could result in huge upside for the brand. Also, another positive thing about STLA going into 2025, if you're looking for income, Stellantis offers one of the highest dividend yields in the auto industry. Their dividend payout is strong, and they continue to generate healthy cash flow, which should support these payments. Stellantis has declared an annual dividend of 68 cents per share with an ex-dividend date of April 22nd, 2025, and a payment date of May 5th, 2025. So if you want to get paid for this dividend, it's time to get in now before late April. This represents a decrease, although this represents a decrease from the previous year's dividend of $1.65 per share. Based on the stock's current price of $12.82, the forward dividend yield is approximately 5.3 to 6%. Historically, Stellantis has paid dividends annually, with amounts varying over the years. Investors should note that dividend declarations can change based on the company's financial performance and strategic decisions. Given Stellantis' strategic push into EVs and autonomous driving, I could see the stock hitting $20 or more per share by the end of 2025. It was last over $20 in June of 2024 previously, this past year, peaking at $28 last February. With the position of Tesla declining and with the politicalization of Tesla and the relation of it and how the tariffs might impact this in the EU, and EU consumers are using Teslas less and less with their disdain towards Elon Musk, this could very well step up for STLA, and they could take a significant portion of this EV maker's auto share within the next 5 years, I would assume, especially alongside these toxic political climates increasing. So, strong buy STLA. Check it out. For my fourth pick, if you're looking for a fintech disruptor, look no further than SoFi Technologies, ticker symbol SOFI. SoFi has rapidly grown from student loan refinancing platform to a full-service digital bank with offerings that span personal loans, mortgages, investing, insurance, and credit cards. SoFi has consistently grown its top-line revenue, fueled by its expanding member base, diversified financial services, and increasing deposit growth. In 2024, SoFi reported record earnings, and the company is now on track to achieve full-year GAAP profitability in 2025, a major milestone that could continue to drive institutional investment and strong price appreciation. SoFi's one-stop shop model, offering banking, investing, lending, and a financial planning under one platform, creates strong cross-selling opportunities. As customers use multiple SoFi products, it boosts retention in revenue per user, increasing long-term profitability. SoFi Bank continues to expand its deposit base, allowing it to fund loans at lower costs compared to traditional lenders. With student loan repayments resuming and personal loan demand remaining strong, SoFi's lending division is expected to grow in 2025 in both volume and margins. SoFi's technology platform, powered by Galileo and Technisys, provides business to business (B2B) fintech infrastructure services to other companies. As more banks and fintech firms integrate Galileo's payment system solutions, this segment could drive significant high margin revenue moving into this year, into the next 5 years, into the next 10 years, as SoFi continues to pick up more market share. With the Federal Reserve expected to cut interest rates in 2025, not as much as it did in the previous year, but it's still estimated to cut 4 to 5 times, SoFi's costs of funding could decline, improving its net margin NIM in lending profitability. Additionally, regulatory clarity on fintech banks could benefit SoFi, solidifying its competitive advantage against legacy banks. As SoFi transitions to consistent profitability, it could attract more institutional investors and analysts, leading to a higher valuation. With strong fundamentals, SoFi could trade at a premium to traditional banks due to its higher growth rate, younger consumer focus, tech-driven approach, and being a scalable platform. With growing revenues, profitability milestones, an expanding financial ecosystem, and strong macro tailwinds, the company is well positioned for sustained growth. As it cements its position as a leader in digital banking, SoFi could see significant upside for potential long-term investors. So currently, SoFi, I believe, is pretty oversold, but a lot of analysts are rating it as a hold. It's a little bit more skeptical on the side of this top five. The chance of it bouncing to my stock price target isn't the most realistic, but I believe in its long-term upside. So for this year, I set my price target for $30, which would more than double in price at its current share price. But I believe that with this growing momentum in the stocks bouncing back and the financial sector bouncing back, along with Discover on their dip and AI on their dip, all of technology is oversold. It also includes fintech. We could see a huge upside and bounce back for SoFi. So buy to sell while you can. And last but not least, my pick number 5 is the AI chip king, NVIDIA. NVIDIA, if you've been paying attention to the rise of AI, NVIDIA's GPUs are the backbone of the AI revolution. They dominate the data center and gaming GPU market, and in 2025, I expect even more dominance. NVIDIA remains a must-watch stock for this year, as it continues to dominate the AI, data center, and semiconductor industries. The company's GPUs are at the heart of the AI revolution, powering advanced applications in generative AI, machine learning, and cloud computing. With demand soaring for high-performance computing, NVIDIA's Hopper and Blackwell GPU architectures are setting new industry standards, making them the go-to choice for AI leaders like OpenAI, Google, Amazon, and Microsoft, which are all strong buys. Except OpenAI, they haven't gone public yet, but they're looking to be shifted into a for-profit company. That's besides the point. As AI adoption expands into healthcare, finance, and robotics, NVIDIA is uniquely positioned to capitalize on this rapid growth. Additionally, its CUDA software ecosystem gives it a significant competitive edge, locking in customers and ensuring continued long-term demand for its hardware. Beyond AI, NVIDIA is expanding its reach across multiple high-growth sectors. Its data center division is experiencing record-breaking growth, driven by AI-related investments from major cloud providers. Meanwhile, its gaming segment remains a core revenue driver, with the RTX 40 series GPUs continuing to dominate the market. The company is also making strides in autonomous driving, with NVIDIA Drive powering next-generation self-driving technology. Furthermore, NVIDIA's push into the industrial metaverse and digital twins through Omniverse opens up yet another multi-billion-dollar opportunity. With multiple revenue streams, continuous innovation, and a strong financial look, NVIDIA is one of the most compelling stocks to watch in 2025, as it continues to lead the AI-driven transformation of technology. NVIDIA's recent financial performance underscores its robust position in the AI and semiconductor markets. In fourth quarter earnings, of Q4 2024, ending in January 26, 2025, the company reported record revenue of $39.3 billion, marking a 12% increase from the previous quarter and a 78% surge compared to the same period last year. This impressive growth was primarily driven by its data center segment, which achieved a record revenue of $35.6 billion, reflecting a 16% sequential rise and a 93% year-over-year increase. For the full fiscal year, NVIDIA's revenue reached $130.5 billion, more than doubling from the prior year, with 114% annual growth. And this was reflected in their stock rise last year, which rose over 100%. As of March 6, 2025, NVIDIA's stock, NVDA, is trading at approximately $110 per share, $110.36 to be exact, down from its 52-week high of $153.13. Despite recent market fluctuations, analysts remain optimistic about NVIDIA's growth prospects. The average 12-month price target among 42 analysts is $177.41 per share, significant increase over this current price of over $60. That's a huge upside for a company that's, well, now it's under a $3 trillion market cap, but a company that touched $3 trillion, and being one of the first companies to do so, suggesting a potential upside of over 50% from current levels. This bullish outlook is supported by NVIDIA's strong financial performance and its leadership in AI and data center technologies. With all these growth catalysts, I see NVIDIA continuing its upward trajectory, potentially hitting 150 to 170 per share by the end of 2025, especially bouncing back from this current dip, driven by AI and gaming growth. Anything below $120 a share is a golden buy opportunity, in my opinion, and I am buying on these levels. For more information on NVIDIA, check out my video linked above on why I believe NVIDIA will bounce back over its all-time highs this year, and I made this video prior to earnings before it took a catastrophic decrease, but I am still holding on for the long term and buying at these levels. It's a sale, and I'm taking advantage of it. So there you have it. Google, DFS, Stellantis, SoFi, and NVDA, NVIDIA. 5 stocks I'm watching closely this year. Each one has strong fundamentals, clear growth potential, and could bring solid returns over the next year. And best of yet, they are all on sale right now. What do you think? Are you buying any of these stocks? Drop a comment below and let's discuss. If you have enjoyed this breakdown, make sure to leave a like and subscribe so you never miss any update on my latest stock picks and investing research. Thanks for watching. My name's Zach from Profit Playfield. I'll see you next week.